It's not a matter of the market really pushing rates up. It wasn't a matter of lack of capital.
So we've been through some changes. So give us kind of like, boom, what's your snapshot of 2020? What happened? Where's the industry going? And then what are you seeing in 2021 for the lending industry?
Well, 2020 was a surprise to all of us, right? When you come into it, you didn't realize what was going to come. Then you've got the virus that comes, and then of course the impact on the markets was almost overnight felt. You didn't realize it until it attacked you, and then when it attacked us, it was pretty rough. To the extent that all of a sudden interest rates just started going up. I'm not understanding why. There was no data to explain to me what's driving the rates up. Why is the mortgage-backed securities having all this massive sell-off? There's nothing that we could see. And when you start looking back on the mortgage-backed securities and you start seeing that big sell-off, that big drop, and then the news started to slowly come out. I was contacting my head of secondary marketing, which is the guys who do all the trading of the mortgage-backed securities instruments within the company, determine what we have for interest rates. They help us publish the rates, and that's the rates we sell. So when I was able to understand that through the information they were providing me, to see that it's not a matter of the market really pushing rates up. It wasn't a matter of lack of capital. What it got down to was, when you look back in early March, when the stock market took that massive header into the concrete there, you started to see that the banks that were investing into those markets, you have people who deposit their money into a checking savings account, just doesn't go into a vault and grow out of thin air, right? The bank itself has to take that money, put it to work, invest in it. It used to be invest in the community. Now they're trying to invest it globally. Well, when they're investing that money globally and the markets took that major shift, you have margin calls, right? Because most of them are leveraging that capital on margin out in the equity markets. Well, those margin calls came. Those margin calls, that's not one of those situations where it's like, hey, pay us when you get some time. Like, you owe this now, right? That's a DEFCON 2 situation. You pay us immediately. Well, when you're in that scenario, they had to sell assets. What are those assets? If they don't have hard assets in the form of real estate or something like that, they have mortgage-backed securities. They have bonds. They have treasuries. They have other things that are set value. So they started selling those assets. And in selling those assets, the mortgage-backed securities started to drop. Interest rates rose quickly, very quickly. So what started with that was, one, a complete, almost just shut down of the industry itself. Just nothing was moving, and people were not locking. What I started finding is there'd be little windows where you could lock. So I would spend my day just refreshing. And I'd find these little windows where I could sit down and lock like 30, 40 loans, and then the window would close. And then my team would keep progressing. So I found ways to navigate through that mess. But what came as a result was, at the end of 2000, I believe it was the end of March, I believe it was March 20th, it's when the Federal Reserve started dumping capital into the mortgage-backed securities. Between March 20th and March 30th is well over $1 trillion. Now, to illustrate how big that is, go way back to the crash of 2008. You had 2009 when they started quantitative easing, right? So from 2009 to 2010, they started January 1, 2009, the quantitative easing, where the Federal Reserve started dumping money into mortgage-backed securities, and to try and right the ship when it come to what was going on with the economy at that point. As far as mortgages at that point, we're at a complete standstill. So they're trying to add capital for people to borrow, the banks to lend out, so that way get the economy stimulated again. Well, between January 1, 2009, the end of March 2010, right? So that's 15 months. They had injected $1.25 trillion into that. Then they maintained a quantitative easing anywhere from $20 to $40 billion a month, swinging around in there till the end of 2017. And then you saw what happened in 2018. Now you get forward into where we are with COVID. They dumped as much in 10 days as what they did in a year and 3 months back in 2008 or 2009.
That's pretty unbelievable. Just to make sure to just capture that again, what you just said. So between 10 days, March 20th to about March 30th, over $1 trillion in 10 days versus the old 2008 market, let's just say 09, in 15 months, they did 1.25 trillion. So it's essentially about the same, but doing about 10 days. A fair summary, Aaron?
Yeah, completely compressed, right? They dumped all this capital in just to get back to where, and just put us on the trajectory we were already on. So if you look at the markets, I don't even know if I can do a share screen here or not. We don't have that capability. If you have the capability to make me co-host, I can do a share screen and show you the charts of where they did all this. And so then what it is kind of, it got us kind of back in the trajectory we were heading, but at a little bit of more of a rapid pace because the market was not doing that kind of thing at the time. So once they got it, then it leveled it out. So what you had is I think it was John Malden and a few other people that they're very deep into the economics of all these things. Barry Habib, others that understand mortgage-backed securities. These guys had then shot information off to the Fed. They got a hold of the chairman of the Fed saying, listen, you don't want to keep doing this. You keep dumping that kind of capital in, you're going to drive the interest rates so far, so fast that the servicing side of the industry is going to lose so much money that they're not going to be able to continue. We're going to have even bigger problem on our hands. And so what that means is, when people when you have a mortgage, right, and you close on it, and about 30 days later, you're going to get a letter saying that, from a different lender saying, we now own it, right? You're going to pay us. Well, they don't own the loan. The loan is already owned by whoever put their money into the pool on Wall Street. It's already owned by somebody else. That's the servicing rights. So those servicing rights were purchased by somebody, usually 1% of the loan amount. So if it was a $100,000 loan, they would have paid $1,000 to get the rights to service that loan. And as you're making payments, they get to keep, say, 30 basis points. So over a 1-year period, they paid $1,000 to get your loan, but they're going to make $300 a year on that if you're religious with your payments. Well, it's going to take at least 4 years to break even, right? Just simple math shows that. And if people are refinancing before that 4-year period, they're losing significant amounts of money. So what was happening here is the Fed was stimulating these refis so fast that the servicing side of the industry said, whoa, we're no longer going to pay for your mortgages. We're not going to buy the servicing rights. In fact, you're going to pay us. And because of that, rates spiked significantly, even though the Federal Reserve put enough capital in there to have brought rates even lower than where they were at that time. But they had to increase it to pay the servicer just to take the loan, because Wall Street couldn't service it. They don't have the capability to service a loan. So they had to incentivize these large companies that do that for their business to take that on and take those payments and they're going to make money on top of the money they were making. So you had that as a transition in our industry. It went from something people would stand in line to buy to now, none of us want it, you better pay us to take it. And now instead of a bid ask type deal where they bid on it and they negotiate to pay for it, now it's like whoever is going to get it for the least amount of upfront capital to buy to get to take that loan, or that group of loans, or tens of billions of dollars in loans, right?
So here's the question I have given that, and that's amazing. And thank you for seeing that detail.